All right, should be recording now. Hello, welcome to session 12 of our summer 2023 Money Matters Financial Wellness series. I'm Brian Bolton, professor of finance at UL Lafayette. Today's topic is the second half of discussions about financial aspects of your side hustle. Not really the second half, it's just an extension or different topics. This is a topic we could spend an entire semester on. In fact, next spring 2024, I'm going to be doing a full 15-week online course in the financial aspects of your side hustle. So we're going to rush through some topics today in not great detail, not great depth, but feel free to reach out to me at brian.bolton at Louisiana. We can have one-on-one consultation, or I can give you more information about that course. It'll be an elective within the management online program at UL Lafayette. That's all I know. I know the content. That's all I know. This slide deck and many others will be posted to the UL System website. They're also going to be posted on my personal business website at business.louisiana.edu/financespersonal. For the past 10 weeks or 10 sessions, I've been repeating the mantra that finance is personal. That may be the least relevant to our side hustle, entrepreneurship, business planning conversations. Yes, your business is going to be unique. Yes, your side hustle, hobby activities are going to be unique to your relationship with your family, all that. But what I'm going to be presenting today is maybe some tax guidance, some business financial planning metrics that apply to everyone. So maybe side hustle finance is less personal than some of the other topics we've been covering, but still we want to apply it to your situation. There we are, bottom left, July 25th, session 12 of 15. We'll be back here tomorrow at noon to extend our conversation about savings accounts. And when many of us think about savings, we think of it as a chore, and it does take effort for many of us. And tomorrow we'll kind of shift from emergency funds and obligations to let's save for some fun stuff. We work for opportunity to enjoy some fun stuff. So let's talk about financial planning and paying and saving for those. So that's tomorrow. But today, the financial aspects of your side hustle. We'll go through 4 topics. Talk a little bit more about taxes. We talked about taxes some in session 1 5 weeks ago. Talk about taxes. We'll talk about profitability, how to measure it. We'll talk about expansion and how that's important for many companies, but also very difficult. Then we'll think kind of philosophically about success, or philosophically, but also a little bit practically. What do you do when you achieve success? I'll remind ourselves in 20 minutes that we all define success differently. All businesses define success differently. So, but we'll think about what our options are when we kind of get over the hump of the difficulty of starting a new business and maybe have some opportunity to enjoy it. As with anything we do, we're trying to achieve happiness. If with a business, we're trying to create mission or purpose or social impact or just money, wealth. That's all rolled into this happiness ideology that we've been talking about. Conflicts between short-term and long-term goals, conflicts between family needs, personal needs, financial needs, all within the constraints of trying to run a business or turn a side hustle into a business, whatever that may be for you. My quotes, takes as much energy to plan as it does to wish, probably hits most personal or the most relevant with side hustles. The most difficult thing is the decision to act. The rest is mere tenacity. That certainly applies. Starting a business or turning a side hustle into a successful business is not easy. We'll go through some statistics in a little bit. It's not easy. It takes a heck of a lot of work. If you're working full-time for the university or for the system, transitioning or turning a hobby, a part-time hobby, into a successful business takes both planning and tenacity, just to make it worth your time, even if you're not concerned about profitability or financial success. Just to make it worth your time and not a headache, it takes a heck of a lot of work. And so we'll talk about kind of what that work may bring you throughout today. Start with our values or goals, trying to get, what are we trying to get to? Where are we today? And we create some personal financial plan. What's unique about today is we're taking our career and connecting it to all these elements, turning our career into maybe planning for our business, creating or launching our own business. And I know I keep saying entrepreneur and business. If your side hustle is just a hobby, just an activity you're doing totally on the side, everything else, everything we're saying here still fits. If you're trying to turn your side hustle into maybe a business that you could take over full time, I want to prepare you for that, or give you some perspective on what that may entail. So if you just want your hobby to be a side hustle, great. We're talking about that too. We're not only talking about trying to create the next Microsoft or Tesla, but there are financial implications to your side hustle or to your hobby that we want to be aware of. And those implications are similar for the most part to any business. And so that's why I'm conflating or merging these terms. There are some differences that we'll talk about in taxes, but a lot of the ideology and the strategy is going to be the same. Just a reminder of what we did in session 1. We talked about you may be an entrepreneur without knowing it. If you are selling anything, whether it's you're doing consulting and selling your time, or you're selling lemonade or cookies, yeah, you're an entrepreneur. We talked about taxes, and the key issue there is every dollar of revenue you get is potentially taxable by either the state and or federal governments. We talked about protecting your personal assets through getting some legal business liability and what the concerns there are. And if you create an LLC, limited liability company, a limited partnership, or a corporation, you can insulate your personal assets from business liability, which you probably want to do. But you may or may not want to separate your business and personal lives. There are some ways you definitely want to, such as accounting and financial management. But maybe you want your spouse or children to be working with you. Maybe you want to turn your hobby into a family business. And that may be really beneficial both for the business and for the family situations. Whatever you do, whether it's just, I guess if it's just a really casual hobby, it may not take too much effort and energy on behalf of your family, but you may be spending family money on that hobby. And whatever you do, have a conversation. Talk to your family, other loved ones about this initiative, this activity, and make sure that your activity, your dream, your goal, whatever it is, does not compromise their dreams, goals, at least not without their support, their blessing. That's what we did a month ago, 5 weeks ago. We're going to talk about 4 issues today. We'll spend a little more time on taxes, talk about taxes in a slightly different way. We'll talk about measuring profitability, how to measure it and how to plan for it. There's different ways to measure it. We'll talk about a couple specific ones. Talk about expanding. What does it mean? You have successful cookie cut kiosks downtown, or you're selling stuff at the farmer's market on weekends. How do you go from a booth at the farmer's market to a real storefront? How and why? We'll talk about that quickly. Again, in 45 minutes, it may not be possible to go into detail with that, but we'll touch on it. And then finally, we conclude with success. Assuming you achieve it, whatever that means to you, financial success or otherwise, what do you do? What are your options? And the options are, success by its nature is a good word. We like that. And so the options are good. There are trade-offs with the options, but we want to at least be aware and begin thinking about what those options might be. Yes, even as soon as you start, turn your side hustle into a business, you want to think about what success looks like and how you plan and prepare for it. If you just have a hobby side hustle that you want it to stay there, just something fun to do on weekends or in evenings to turn your hobby into a little bit of cash flow, success may be as simple as having fun, right? And you're willing to lose a couple $100 a month for this project, for this hobby, great. That success part might not be as relevant to you. But I think everything else that we talk about will be relevant to you, whether your side hustle is just selling something or consulting for a few hours a month, or again, trying to become the next Microsoft or Tesla. So let's go back to kind of the beginning of financial planning 101. Think about how we report our financial activities, transactions. And so I've got this entrepreneur stakeholders and making money. And the making money is at the bottom. Making money is the net income. This is an abbreviated income statement or statement of operations. You may have heard a P&L statement, profit and loss statement, same thing. That's what this is. Down at the bottom, that's where the loss would be, that's where the profit would be. Net income, net profit are the same thing. Anytime I use the word income on here, you can replace that with profit. You can replace the word margin with profit. One of the annoying things about finance and accounting people, or not necessarily people, our world, is we use our own language and we use words interchangeably. We use words that you use in English, but we use it maybe in different ways. And so a lot of people maybe don't realize that profit and income are the same thing, or profit and margin are kind of the same thing. Sorry, it's what we do. And our own language, you need some translation, and Google Translate doesn't help with that. It's just kind of getting familiar with what our lingo is and what we're trying to show. This is an income statement. And this is a measure of financial activities, financial transactions. Where do these transactions come from? Every dollar of revenue that any company has ever made, the money that's coming in, comes from customers. The exception kind of is grants. So if you're a nonprofit company, your revenues maybe come from a different source. But if you're a for-profit company, your money comes from customers. They give us their money. They give us their money because they think we're making their lives better. You're selling cookies, people like the cookie, they're willing to give you $3 for a cookie because that cookie makes them happy, right? Very simple. Consulting, if you're providing consulting services, your services make their lives easier or better. Excuse me. We get revenue. Any business gets revenue because customers give it to us in exchange for something. We have to make our customers happy. When we give them something, it's because we produced something, and that production could be either time or a product. Accountants refer to this as cost of goods sold, the expense that we incur to create the products, to create the sales, we call cost of goods sold. And who makes cost of goods sold happen? Cost of goods sold happy? Our employees and our suppliers. And so the suppliers give us the raw materials that we transform into some cool product. Our employees do that transformation. We, the business owners, we have to give cash to those suppliers and to those employees to make that happen. We subtract revenues, we subtract cost of goods sold from revenues to get gross margin. Gross margin will come back in a second when we look at profitability. And it's just a measure of how much money we're making on each sale or on our sales directly. So cost of goods sold, the expenses we incur directly for each product. Operating expenses, we call that overhead. So you've probably heard of overhead. This is the infrastructure, operating expenses that we have to pay to create the business. So that could be the landlord, the advertising agency, the utilities company, advertising, marketing, legal, all those things that we're still going to be paying even if we never ever generate $1 of revenue, right? So if we never generate revenue, we have zero cost of goods sold, but we might still have a whole bunch of operating expenses. We might have a whole bunch of overhead because we pay the landlord, we pay the light bills, we have some salary, we have some employees. So operating expenses will also include a lot of compensation or salary expenses, employees, right? And so we're still going to be paying that even if we never ever sell anything and get revenue. We might not be in business long if we don't do that, but we're still going to have those. And so another way to look at this is cost of goods sold are variable expenses. They vary with the number of units or the amount of sales that we have, whereas operating expenses are fixed. they don't change. Whether we sell 100 units or 1,000,000 units, our operating expenses are going to be basically the same. At least that's how accountants think. That's not necessarily true, right? If you sell 100 units, maybe you need one warehouse. If you sell 1,000,000 units, maybe you need 5 warehouses or whatever the math is. And so your overhead is going to be a little bit different, but the basic idea is the same: fixed versus variable. Variable is the cost of goods sold that directly relates to the revenues. Operating expenses, overhead that we have to incur regardless of what our revenues are. And then most income statements are going to have some line called other expenses. We give cash to the bank maybe for interest expense. Maybe there's some non-recurring, non-operating sources in exchange for certain benefits. So maybe the legal expenses we incur to launch our business the very first day, that may be included in other expenses. Expenses we'll never ever incur again. Things like that are not really part of operations. You'll notice the line above we call operating income. For many entrepreneurs, this is the most important number. That this is a real measure of performance, operating income, because that's a measure of, does my idea work? Do people care about my idea, my business? And am I running the business both efficiently and effectively? Whereas the other expenses are unusual, non-operating, kind of weird stuff, but they still happen, still cash, but it's not necessarily part of the business operations or strategy. And these could be just about anything. Then we pay the government. We give the government cash because they give us the social infrastructure for a business to succeed, at least in theory. I think for most businesses, at least somewhat true. You may disagree about the amount you're taxed, but there's probably some benefit and some infrastructure to having that the government provides that enables or facilitates business operations. If you don't agree with that, I encourage you to go to much smaller developing economy countries and check out how easy it is to be an entrepreneur there. And the answer is most countries it's much more difficult. And so, and you could also include, education. Having a well-educated workforce probably makes your business more successful. Anyway, enough about that. But income taxes, we have to pay those if we have positive income. We'll return to that in just a second. If our taxable income is negative, we don't owe the government anything. And then finally, the bottom line is net income. Net income, this net profit, after we make our customers happy, pay all of our other stakeholders who made the business possible. Whatever cash is left over is ours to keep. We can give to our family, buy a boat, return to outside investors, do whatever we want, including reinvesting in the business. We'll talk about success in a little bit. This is kind of how we're going to measure success. And I say kind of because your definition of success might be different. This is where we'll start. You can adjust the definition for what you want. So let's talk about taxes. As we talked about 5 weeks ago, any dollar of income you get, whether it's from selling cookies or winning at the casino and consulting for many of you, is considered taxable income by the IRS. And I say potentially because we get to deduct expenses. So if your expenses are greater than your revenue, you don't have any taxable income. But the IRS wants us to report every penny that we receive, not just the net, but the gross. And the gross is the total amount of cash that came in from customers or grants or other sources of revenue. We have to report it. Reporting doesn't mean that we have to pay taxes on it, because you can offset any income received from your side hustle with the expenses associated with creating that income. You sell $500 of cookies, you spent $500 on raw materials or the cost of goods sold to make those cookies. $500 of revenue, $500 of cost of goods sold, your gross margin is zero, everything else is zero, you don't have any taxable income. So the $500 of revenue doesn't get taxed. The 500 minus expenses is what's potentially going to get taxed. And for those of us who are small-time entrepreneurs, we're not opening skyscrapers, offices downtown, we're working out of our houses or small-scale business. Some of our business property can be used for personal purposes and vice versa. And when we do that, we can recognize that personal asset as a business expense, as a business deduction. Deduction and expense basically mean the same thing. From a taxation perspective, that's good. And so what's an example? If my vehicle, I have a business vehicle that I use to take my children to school, that's totally legal, that's fine. The business still gets the depreciation or the operating expense associated with the vehicle. I'm supposed to separate business from personal activities with that vehicle. But if I'm driving my children to school, I get a flat tire, I have to spend $200 to replace and fix and replace the tire. That $200 is a business expense, even though I was taking my children to school at the time it happened. It's a business vehicle. I have to fix the tire to run my business. And so for many of us, again, small time, side hustle, hobby entrepreneurs, we have a fair bit of totally legal leeway in merging personal and business expenses. In the last session, we talked about the home office. If you're working out of your house, you can't use all of your house expenses as business expenses, but you can, if you have a 2,000 square foot house and a 400 square foot room or basement is being used for business, 400 divided by 2,000 is 20%. 20% of your house expenses can be applied as a business deduction or business expense. These are all good, right? You would be spending that money anyway, even if you're not using the basement for business purposes. But now you get to get a little cash back for your mortgage, utilities, insurance, and other home ownership. Be very careful when you do this, when you take business deductions for personal items. Totally legal, totally possible, but they're also yellow flags for IRS agents in that a lot of people like to try to do this. And so the IRS just wants to make sure that you're doing it properly and appropriately. Again, can be totally legal, but if your moral compass is a little misguided, it can also be a place where you take some creative financial liberties and the IRS may want to talk to you. So just be very careful in recognizing personal expenses as business expenses. More on taxes, talking about the difference between a side hustle and a real business. When it comes to taxes, that does matter. For most of what we're talking about, strategy, success, some other things, maybe it doesn't matter philosophically. For tax purposes, it does. And according to the IRS, their rule of thumb is if your business earns a profit in 3 out of 5 years, looking back or potentially projecting forward, the IRS will consider your business a business, and you can use these business deductions in the current period and carry any losses forward in the future years. That's really good. However, on the other flip side, if your business is just a side hustle or a hobby, you're not trying to make a profit, you've never made a profit, you're not doing big, you're not looking to expand, you're not looking to market or anything like that you might do if you're trying to become the next Microsoft. If it's just a side hustle or a hobby, you can offset hobby expenses against hobby income to have zero net. We'll do some math on the next slide. But you cannot carry the losses forward to future years. I say it's not that good. It's not terrible, but you don't get the same benefit if you're actually trying to be a business. And so the trade-off in being a business, getting recognized as a business, is all the work you have to do to achieve a profit, right? And the IRS wants to reward serious businesses. They want to encourage you to create the next Microsoft. But they have to draw the line somewhere, right? And they can't give benefits to everyone just for having hobbies. Where do you draw the line? Is exercising, video games, books, and those are personal endeavors. And if I were to claim that those are my business, that might look a little fishy, right? And I think from a business perspective, it is fishy, right? Me going to the gym, hard to argue that that's in the broadest, best interest of society. Or me creating a personal training activity where I'm recognizing revenue and expenses with a dozen clients or whatever. There's some benefit to society there that the IRS and the federal tax revenue system might want to support. So they have to draw the line. And kind of where they draw the line objectively is your business earns a profit in 3 out of 5 years. You can claim to be a business and get those deductions and carry forward the losses. Otherwise, you're just offsetting revenue and expenses in the same year. Not the worst case. The next slide has that, sorry. So what do you do? If you're just doing the side hustle hobby, how do you report this? 1040 has a form called Schedule C, and that's where you report all business operations. And so we call these pass-through entities, the LLCs, partnerships, sole proprietorships, anything else that's a non-corporation. There's 4 or 5 basic types of legal entities that are businesses, but there's dozens of variations. And so it gets complex, but for most types of entities that we would choose, we call these pass-through entities. What that pass-through means or refers to is you're still filing taxes as an individual, and the business operations pass through to you on your 1040, your personal tax return. The business does not file its own tax return independent of you. Business exists because of you. If you structure it as a corporation, then that's different. Then we'll have 2 separate tax returns, one for the business, one for you. If you're an LLC, partnership, sole proprietorship, hobbyist, side hustle, you'll fill out Schedule C. That will show both revenues and expenses. These will flow through to you. Again, math on the next slide. Everything we've talked about kind of applies to you if you want to run a nonprofit. So if you want to structure your business as a nonprofit, consulting, mission-built focused, whatever it is, great. You have to register as a corporation with the state. So you can't be an LLC or a partnership or sole proprietorship. You have to be a corporation. And that's not really a problem. Just means it's not a big burden. It just means you pay a little bit more, and you have to have a board of directors that you report to the state. The state will give you an EIN. EIN stands for Employee Identification Number. That is basically the social security number of any business. But it's not as classified or private as a social security number, right? So you can share this and you can give that out, but it's the business identification number. The state will give you the business identification number, the EIN, and then you can use that to report to the IRS, say, hey, I want to have a tax-exempt nonprofit. Show why, go through the application, and the IRS will decide if you get that. I say decide, it's not granted automatically, but the IRS wants to support nonprofits and mission-focused businesses. And so the hurdle to get that nonprofit status is not huge. The hurdle to maintain nonprofit status is simply by is a little bit higher maybe. And you just have to report back to both the state and the federal IRS about what you're doing, making sure that either you didn't make money or you're providing the income statement for the business to the federal government, and just so they make sure there's nothing super fishy, right? You can imagine that nonprofits can be a way to do some creative fraud, if that's the right word. Most are not, but there's maybe more liberty to take some creative liberties with nonprofits than with other businesses. So the IRS does impose some reporting, not a huge burden. Just a reminder, when we talk about nonprofits, and you think about what is a nonprofit versus the for-profit, nonprofit is a tax status. It is not a goal, right? We don't want our business to lose money. We don't want our business to not have profit. We want all business to have profit, including a tax-exempt 501c3 that's recognized by the IRS as a nonprofit. If my nonprofit makes money, that's great. It's not a problem. It's not going to violate anything I'm doing with the IRS. I'll just have to spend that money that I made next year. Hire more employees, run more programs, save more puppies. Whatever I'm trying to do, making a profit allows me to do more. Now, if I'm making big profits every year and building up big assets and paying myself $1 million a year in cash, after a while, the IRS may see that and decide, okay, there's something wrong there. However, the first people that should be judging that are the people that donate money to the nonprofit, right? And so if they're fine with me paying myself $1 million salary for not really serving the mission, and I can get away with that from them, then it may be a while before the IRS figures it out. But the IRS probably will. Regardless, everything we're talking about applies to nonprofits. Being a nonprofit is a tax status. It is not a goal for anyone. And so let's look at some math. And we're talking about side hustles. Imagine your salary from your day job is $100,000, just to make the math easy. You got a day job salary of $100,000, and on the weekends you're selling cookies. You've got a hobby or a business. Could be either. Again, it could be legitimate business, 3 out of 5 years of profitability, or a hobby you just do on the side. Let's say you brought in 15,000 of revenue, you had 10,000 of expenses. So you do the math. The business earned 15 minus 10 equals $5,000. That will flow through both hobby and business. It'll flow through and add on to your 1040 to your income. So your total personal income for the year will be 100,000 plus the 5,000. Pretty straightforward. Option 2, now we lost money. Still have $100,000 salary. We still sold $15,000 worth of cookies, but now we had $20,000 of expenses. So we lost $5,000. First, let's talk about hobby. As a hobby, total income, personal income for the year will be 100,000. The 5,000 hobby loss does not help you. You can't do anything with it. You lost 5,000 this year. Poof, it's gone. You'll never see it again. Right? Maybe that's fine. But if you're a business, same situation, $100,000 salary, $15,000 revenue, $20,000 loss, $5,000 business loss. Your personal income for the year will still be $100,000, but that $5,000 loss is not gone. No poof. It still exists. You can hold on to it and you can apply it to future years' business operations. And so if you earn a profit in the future, you have a taxable profit or a presumably taxable profit, you can apply that $5,000 to that taxable profit to reduce it, to make your actual taxable profit in the future less. That's great. And that's the big difference between a hobby and a business from IRS perspective, is what happens to losses. For the most part, gains, profits, income, they're taxed essentially the same, maybe identically the same. Losses are treated differently. And again, the IRS has to draw the line somewhere. They don't want me spending $10,000 a year on my exercise habit, my hobby, and being able to write off that $10,000 of exercise equipment and classes and training as a business expense if I'm not really doing any business type activity. And that's where they've drawn the line. If you have a business that's benefiting others, benefiting society, the IRS wants to give you some benefits. If it's a hobby, kind of just for fun, that is far more marginally impacting society. Sorry, the benefits are relatively minor. But you still have the benefits within the year, but you can't roll those forward. So that's taxes. Let's talk about profitability, or pardon, success. This is a little out of order, I apologize. But as we think about beginning to measure success, I want to remind ourselves that it's difficult to run a successful business. 80% of businesses with employees is the key, because that means a little bit larger and you have employee expenses. 80% of businesses survive the first year, which means 20% don't. 1 in 5 do not survive the first year. 3 in 10 do not survive the second year, half don't survive 5 years, and then 70% of our startup businesses are gone by the 10th year. So it's difficult. As we think about success, how do we measure it? How are we going to become one of those 30% that are still around after 10 years? Place to start is by looking at going back to our income statement and talking about break-even analysis. In short, we'll talk about success measured by net income or profit. In this case, profitability measured by net profit. Different entrepreneurs will have different definitions of success. In theory, if you have unlimited resources, they could throw out the business or hobby, your business can succeed forever. Look at what Elon Musk is doing with Twitter or X or whatever it's called today. He can keep throwing a whole lot of money. He's got billions. He can keep throwing a whole lot of money. And it's, I guess legally it's a business, but you could also argue it's kind of his hobby. And he's about as close as we have to someone with unlimited resources and maybe uniquely willing to throw those unlimited resources at his hobby. Most of us don't have that luxury. Most of us need to earn a profit, or at least make enough revenue to offset our expenses. And so let's talk about something called break-even analysis. What is break-even analysis? It's a measure of what we need to do to break even. How many units do we need to sell to break even? And we could adjust this for consulting, where your units are hours of work time. We could adjust this for companies with 20 different products. If you're a restaurant, you can, or a coffee shop, you can say, okay, how many lattes do I need to sell to break even? Or you can say, how many customers do I have, assuming the average customer spends, $10 on coffee plus, a croissant, whatever. So we can adjust this, but this is the basic model. In general, in order to break even, if we're losing money, we can either decrease our expenses, lower our expenses, or increase our sales. Pretty much it, right? Break-even analysis focuses on the sales. How many units do we need to sell to break even? So the math is, we take our fixed costs. Remember 15 minutes ago, we looked at the income statement on the right, identified the operating expenses as the fixed expenses. We have to pay those. We have to keep the lights on. We have to have the doors open to the building, to the warehouse. So we have to pay those. We're committed. How many units do we have to sell? And the denominator here, the selling price per unit minus the variable cost per unit, that's the top two rows divided by the number of units. That's our gross margin per unit. How much money does each unit sale bring in? So if you're selling cookies and you sell each cookie for $3, and you do the math and you figure out it cost me $2.50 to make each cookie, then your gross margin per cookie is 50 cents. And so then you need to figure out, okay, if I'm making 50 cents net per sale, how many cookies do I need to sell to break even? And that's what break-even analysis tells you. Again, we can modify this for service businesses, consulting firms. Point is, you're trying to estimate how many things you need to sell in order to cover all of your expenses, both your variable costs and your fixed costs. Note that all your expenses are in this formula. Fixed costs in the numerator, variable costs subtracted out in the denominator. That's it. With 20% of businesses failing the first year, it's because they never broke even, or they didn't have enough financial slack, as we call it, to lose money for a period of time. And they just didn't break even, so they had to shut down. As soon as you break even, that gives you a whole lot more flexibility. And again, I apologize for the sloppiness of these slides, but you get what we're talking about. There are many other ways to measure profitability and to measure success. Break even is lesson 101 in profitability and success. For an entrepreneur, if you break even, then you've got a whole lot more options. But then once you break even, you can begin thinking about expansion. Or maybe, in some cases, you have to think about expansion beforehand. If your margins per sale are very small, like an Amazon or a Walmart, most grocery stores, for each sale, they don't make a lot of money, right? They make a penny or two. And that penny or two doesn't pay for the building, the warehouse. They need to make lots and lots of sales to break even. In some businesses, this will be the case. And so you may need to expand, but expanding makes your business exponentially more complicated. Logistics, legal, overhead, all these different items that hit our income statement, they get more complex as your business expands. As you go from that booth at the farmer's market selling cookies to a store downtown, that gets a whole lot more complicated. It's a big leap up. It may open you up to much more revenue opportunity, but that leap in the business sophistication is a big leap. And as you expand, if this starts as a side hustle, it may not be able to stay as a side hustle as you expand, obviously, depending on what type of business you're running. So first ask yourself, do you need to expand and do you want to expand? Can you expand with existing financial resources, either your personal savings or financing you've retained already, or has your business made some money that you've saved up that can allow you to expand? But how are you going to pay for the expansion? Depending on the size, family and friends might not be an option anymore. Credit cards might not be an option either. And so if you're trying to expand your business, you might have to go for bank loans. You might have to establish partnerships either with businesses or with external investors. As you get bigger, as you get more sophisticated, your financing gets more sophisticated. And sophistication brings both great benefits, but also a lot of complexity. And so as you think about expanding, make sure that you've got the ability to support that. And that ability to support comes with infrastructure. And infrastructure involves both physical assets, but also a whole lot of people. And the willingness to hire people, to run the business, to be the backbone, to deal with IT, to deal with legal, deal with marketing. Maybe having a social media manager is the most important investment you can make if you want to expand, depending on your business or industry. But investing in that infrastructure is critical. And investing in infrastructure changes your break-even analysis, right? Because now the fixed expenses, that's the numerator in break-even analysis, that number gets a lot bigger as we have investment in infrastructure, people, and support. So that numerator gets bigger. We have to redo the break-even math. And so as soon as you do that, have a plan for generating that income to support ever-increasing expenses. Increasing expenses is great. Minimizing expenses is never a winning strategy, because investing in infrastructure can be the key to generating revenue. But you also want to make sure that you manage that and that your revenue is generating some margins or some profits that can go to pay for the expansion, or they can go towards profitability. And so as you expand your business, in business schools, we teach kind of think about 4 life cycles of any business: the launch or the introduction, low sales, high costs. That's bad, right? So you have no or little profits, that kind of stinks. And then you kind of get some momentum, you begin growing, you're increasing sales. Maybe you achieve some profits, or maybe your costs are still elevated. Maybe it's difficult to get your costs below your sales during that growth period. Tesla went 10 years before it made profits. It just kept investing in that infrastructure. Many really successful companies invested year after year in infrastructure, kind of through the introduction and growth stages. And then you hit a point where things are clicking, where you're a commodity, you're an annuity, customers know you, customers like you, they're going to consistently give you the revenue for sales. You're able to become more and more efficient with your operations, more streamlined, and you're able to reduce costs. You're not trying to minimize costs, but you do want to reduce costs. And that's where your profits are able to increase. Maybe you get to a point where you're in decline, where your product is stale or not in demand anymore. Your costs are, you're unable to reduce your costs any further. And if your revenue decreases and your costs are constant, you reduce profits. Or maybe you're able to re-energize and you revamp your business, either the revenue or the delivery or something, and get that lifecycle extension that's on the far right. And you, with the lifecycle extension, you probably don't necessarily go back all the way to introduction, again, depending on how you extend, but maybe you go back to growth and just kind of a shock to the business system. This is very common. Every business goes through this in one way or another. For some businesses, the whole time can be compressed to 2 or 3 years. Tesla's probably still in the growth stage after 15 years, and many businesses, this lasts for decades. As you expand, you want to be aware of this timeline and kind of what it costs upfront. Now let's assume you've succeeded. This is the real success part of the conversation. A few things to think about. When you started your business, you probably weren't taking a big salary. You might have been taking a salary, but maybe you were paying yourself below market, below desirable rate. And now you can maybe afford to pay yourself and your most important contributors, employees or partners, investors, whomever. You may have heard the term stock options, and stock options it's not cash salary, but it's restricted option on future profitability. Basically, if this business succeeds, we'll get a lot of money. If this business doesn't succeed, nobody gets anything. And so a lot of tech companies and startup companies give their employees and founders and owners a lot of stock options in exchange for salary or compensation because they don't have cash. But if they hit the home run and the business succeeds, then everyone wins. Now, if your business succeeds, you can actually do both, right? You can pay yourself the salaries. How much do you pay yourself to manage to keep the business going and also reward yourself for all your success? And think about who owns the business. Can you give or sell the business to family, friends, business partners? The answer is legally, you can. There are some IRS limits. And you may want to do this in order to share your success. From an estate planning perspective, we don't talk a lot about estate planning in this course, but from an estate planning perspective, it may make a lot of sense to give your successful business to your children, both to have them succeed you in running the business, but also to spread out the wealth within the family so it's not all concentrated in one person. And so thinking about who owns the business, the day you start, you're going to own 100% probably. Over time, as it becomes more viable, you may want to spread that out. And then think about this. You've succeeded, you hit maturity. What do you do to avoid decline? And avoiding decline, maybe you've generated profits. What do? Do you reinvest those in the business? Or do you take some cash out of the business? I can't tell you one is right. I can't tell you one is wrong. But what you do with the money that you've generated, that you succeed with, that you've created through the success, will dictate what happens next with the business. And one option might be to have the business invest in other businesses. There we go. Now you're a magnet, right? And so by creating businesses within businesses, you haven't taken money out beyond a salary or moderate distributions or dividends. And you just keep growing. And throughout this course, throughout the series, we talk about compound growth. And that's it right there. In the business perspective, compound growth is when you invest in investments. You just keep investing and investing. And that's where the ultimate success comes from. We rushed through this. Again, I'm doing 15 weeks of this one topic, 15 weeks in the spring. We could talk more about this in far more detail. Remind ourselves of what we talked about in session 1, 5 things you can do tomorrow. Build your team. Get the people you need to separate your business, personal lives as much as possible, separate financial transactions, get those. Find an accounting system you like. If you're starting your business, whether you're bringing in $100 a month on a hobby or, again, trying to be in the next Microsoft, accounting properly will make your life so much better. Register your business with the state, again, regardless of your intent. Having it registered with the state will give you flexibility and options. Takes a couple $100, a couple hours, but can, again, give you flexibility and options. And then finally, begin thinking about your business plan, thinking about the narrative of your business, how you could tell the story to others. Before you do that, maybe you wanted to work with the business model canvas. This is what we talked about 5 weeks ago. To me, it's a really cool just visual of what's our business doing. Talk about markets and customers and the external environment. We talk about implementation, operations of how to make your business work. We've got mission and vision at the top. That's what your business is trying to solve. Right in the middle, we've got value proposition. This is what makes your business unique. Are your cookies better than everyone else's cookies? Is your consulting service better than anyone else's consulting service? What makes your business unique? What is your unique value proposition? And then at some point, not with numbers, but just with words, we want to identify our revenue streams and our cost structure. And that will lead to the financial value proposition. I love this because it's a one-page snapshot of the business, whereas a business plan might be a 5-page or a 50-page game plan for the business. If you can't summarize your business adequately with a business model canvas, then that next phase is going to be even more difficult. Again, if you're just doing a side hustle, you don't need to do this, or if you do it, you could keep it very brief, just to have some awareness so you're not really creating more problems for yourself than necessary. We're all trying to get to happiness. How we do that is going to be different for all of us in different ways. But it's also not going to be a straight one. We set our goals, we analyze reality, create a plan, execute the plan, and then adjust the plan. It's all going to be a little bit different. We do that in our personal lives, our academic lives. Same with business. Set goals, create a plan, and then prepare for things to change. That's it for today. We're talking about financial planning for the fun stuff for tomorrow. It's not exactly different from other financial planning, except maybe more exciting. Less of a burden, less of a chore, more of a positive energy, positive excitement. That's what we'll do tomorrow, June 26th, financial planning for the fun stuff. Today has been financial aspects of your side hustle. As I said a few times, we're just touching the surface on this topic. If you want to talk about more, if you've got a real business or a real idea or a side hustle, you really want to understand both the implications of regulation and taxes or the opportunities for yourself to do more and more with what you're trying to do, send me an email, Brian.Bolton, Louisiana, send me an email, and we'll talk and we'll see what we can do and what your options and opportunities are. Thank you for joining. That's it for session 12. I'm going to stop sharing. I'm going to stop recording.